Welcome everybody to the webinar Trading Psychology and Easy Plan with Thomas. I'm Thomas. I will be the one hosting the webinar today. Feel free to ask any questions on the question box. So first of all, I will tell you a little bit about myself. I'm working as a senior account manager here in AvaTrade for the last few years. I had the opportunity to work with many clients and assist them while being able to get a better understanding on what are the main issues and questions that clients are normally having, because I've been working with thousands of clients throughout the years, and I will be happy to share with you today some of the main things that are important and substantially important to understand when you are trading. And the psychology part is a very important part, and I will be able to share with you some of the major things that causes to enhance odds of losing capital, risk management, and everything we will be going through today. We'll start with the risk disclosure. Any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, a recommendation, or suggestion. CFDs are a complex trading instrument and come with a high risk of losing money rapidly due to 57% of retail investor account lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please read our full risk disclosure on our website, avatrade.com. So we start with the webinar agenda. We'll go through a trading basic, profit and loss calculation, type of orders, buy, sell, pending order, and we'll speak about trading psychology. What is trading psychology? What is risk management, risk appetite, how to determine to have a certain risk percentage out of the account, platform essentials, opening, closing trades, pending orders, what is the stop loss and take profit order, margin calculator, trading history, AVAProtect. It is a product that we have launched a few months ago that we'll be discussing as well. The account types and benefits, standard account versus VIP accounts, spreads, interest account that we offer, and in general, what is the account manager service that Ava provide to our clients, how you can use your account manager while trading with our platform. Key account metrics, balance, equity, free margin, use margin, margin level, margin increase, hedging, buy and sell, same time. We'll go through hedging today. Education and constant improvement, how to improve your trading and how to improve your psychology of trading. So this is the first page that you should see when you're logging to your account. We'll show you how it looks like. This is our WebTrader funnel that whenever you log in, you have the option to select to log into the WebTrader. If we start from the beginning, I will just share with you. the screen for the WebTrader. So this is the main screen. You can see here different kind of instrument divided by different sections. We'll go through the trading account overview panel. So here you can see the main overview panel on the right top, and it is divided by balance, free margin, use margin, profit, and equity. The balance represent your closed positions, so it will not include your open trades. The free margin is the amount of money you have available to open new orders, and the equity is the amount of money you have real time, including your open positions. So if you will be closing all of your open trades, you will be left with equity. So this is a very important funnel that you should be familiar with while trading. The used margin represent the amount of margin that was deducted to place the order. So how much margin is required to open your position. If you're going to open a bigger position, it will require more money, more margin to place the order. If you will open a smaller position, it will require less margin to open the position. If you wish to get more margin, you need to make a deposit of funds, and then your margin will increase. Or if you are making profit, also your margin will increase. Margin level is something that is also very important. This will appear only when you open a position. You will see on the right top over here, it will say the margin level in percentage. And this is important for you because it will represent when your position will be stopped out. So when your margin level is below 50% for the EU clients and below 10% for the non-EU clients, then you will get stopped out. If you wish to avoid getting your position closed automatically due to a margin call, due to a stop out, you can either add more money to the account to protect from being stopped out, or you can close a position before getting stopped out, or in the first place you can trade with better risk management that will prevent you getting stopped out in the first place. So in regards to the margin level, you as a trader, you decide what is your risk appetite, and you decide how big of a position you want to use. It is very important also to understand that even if you are trading on a bigger position, it doesn't mean that you need to trade with the whole free margin that you have available. So you can always keep some free margin in your account available to avoid getting to a risky position that will be closer to a stop out. So the margin level in percentage, I will share with you now how it looks like. So once you select the trading instrument that you wish to trade, let's say for the sake of the example, we will talk about US Tech 100. And over here, you can see the required margin to place the order. So let's say if I open a position with the maximum exposure of my account, 0.77 or 0.77 is equivalent to 9,899. Okay, with a leverage of 1 to 200. So if your leverage was, let's say 1 to 20, you will need it will be way higher, the required margin to place the order. It will be almost 100,000 to place this order. So here you can see the required margin is almost $10,000 for 0.77. This is full exposure. What does it mean full exposure? It means that you are using all of your free margin to place the order, and this will put you in a spot that your margin level will be almost at 100%. For the sake of the example, we'll open the order. And now what you see that your free margin is in negative. It means you don't have any free margin available. Your margin level is at 99%, 100% now. And this is because you have used all of your available margin. And now you are getting closer to a stop out. Whenever this number will reach below 10% in margin level for this account because it's outside of EU, and 50% for the EU clients. So if you wish to avoid it, what you can do, you can just open a smaller position size. So you will not be using all of your available margin for the position. Also, what you can do if you go to positions, once you click on the X, there is an option for a partial closure. So you can close a portion from your position. So let's say you close 0.1 lot. If you close 0.1, you can see here, it's giving me the profit that I'm making on the position. So 0.1, once I close the trade, you look at the free margin, how it's going to affect me. And you see for 0.1, my free margin increased. So now my free margin is higher and my margin level is at 122%. Okay, so some clients are asking always, what is the margin level that will put them out of risk or out of risk of having the position closed due to a stop out? And this is not a certain number, okay? This is something that you basically decide whether you want your margin level to be above 100%, above 200%, above 300%. And you see now I got to 120% after closing 0.1 lot. Now, if I will be closing another 0.1 lot, my free margin have gone up almost to $3,000. So I have $3,000 available to place a new order with that amount of money. My margin level have went up to 140%. Okay. So what do we learn from this? We learn that now I'm using a smaller portion for my account. So I started with a full exposure of 100%, and then I closed two positions equivalent to 0.1 and another one with 0.1, and my margin level went up to 140%. If I'm going to close another position of another 0.1 lot, my free margin went up again to almost $4,000, and my margin level went up to 166%, which basically means that I am putting myself further from getting to a stop out position. I'm increasing my available margin. So if the market is going to go against me, I will still be able to keep the position up to a certain extent. Okay, so what do I mean by up to a certain extent? This is something that a lot of traders are not very familiar with, so I will be sharing with you how it's going to work. So look, I put on the search for symbol, I put USD, and now I need to choose my position size. So my current position size is 47. So let's go to USD. We choose 47, which is equivalent to 0.47. Okay, you can see my free margin is 4,100. Now what I'm going to do, I'm going to open a stop loss. I'm going to type 4,100. Okay, and what we can see, what we can learn from this is that when the price of US Tech 100 reach 25,629, my free margin will be 0 because I'm getting into a loss of this amount of money. Okay, and my margin level will reach 100%. Okay, so always you can use our stop loss and take profit calculator to calculate what will be your loss when the market reaches a certain point. Because some of the traders that are looking to trade long term, they are looking to hold positions for longer term, and they don't want to get into the account always to check their margin, although it's always important to look at your account, but it's also important to have a correct risk management. So you don't need always to go and look. You know that you have there enough money to hold the position. If this is your strategy, if this is what you want to do, if you want to hold it. So I'm showing you now when the price of US Tech 100 will reach to 25,637, my margin level will be around 100%. Now it's 173%. Okay? And the calculation is that you check your free margin, okay? And you check the possible loss, okay? And then you know what approximate price will cause me to have reached to that amount, okay? So this is also important in terms of the psychological side of trading, because you do need to learn how to control your emotions and how to have a proper risk management, money management. And it is important to have good psychology, so you have different tools, emotional tools that will allow you to keep your account safe, because it happens quite frequent, very frequent, that clients getting stopped out. And for some of the clients, getting stopped out is part of their strategy, because they are trading on a big exposure, they are trading on a big lot size, and they are counting to make a bigger profit or a bigger loss per each point that the market is moving. So for them, this is relevant to their strategy. But for other traders who want to be more conservative, they could use a smaller portion from the account and trade with a smaller level of risk, or you could trade on a bigger amount with a bigger capital and still keep a big position. Because if your capital is relatively big to the position size, also you will see that your margin level will remain high. So now we can continue with the demonstration. I will remove another 0.3 lot, and you will see my free margin jumps to 8.5 thousand. My margin level jumped to almost 500%, which means I minimize my exposure. Now my exposure is way lower than what it used to be. My free margin is the amount of money I have to place new orders. And this is the explanation about how to navigate throughout your margin level, how you can reduce it or how you can increase it, and what does the margin level really represent. So this is very important lesson for everyone that are having hard time with how it works with the margin level. The margin increase when you do close a position, your margin will increase, as I showed you earlier. Hedging. If you open two positions on the same instrument with the same lot size, but in opposite directions, one buy and one sell, this is called hedging. In a hedge, the margin required to open the second position is close to zero. For example, I will share with you the example live. So look, we are currently open on 17 represent the size of US Tech 100. We have bought 17, and if I decide I want to put a hedge position, I go to US Tech 100 and I open 0.17 lot, sell 0.17 sell. You see the margin is almost zero. And when I open the position, what happened? Now I'm fully hedged. Okay? The only condition to hedge a position is having the margin level above 100%. Okay? So even if it's 100% or 101%, the system will allow you to open a hedge position. Okay? So this situation, what we have the same instrument, US Tech 100. We have the opposite direction, one buy, one sell. We have the same size, 17. Okay? And this is what it called hedge, fully hedged position. Okay? So if one of the position will go up, the other position will go down at some point, and we can leave these two positions. So for the sake of the example, you can see what is happening to them. This is something that many traders really like to use hedging, and some traders they are not really aware of what is hedging. So it's something that you could implement on your own. Getting familiar with the new order page. That's the page I showed you. We have the buy and the sell price. The difference between them is the spreads, the lot size. This is very important. It represents the profit and loss you're going to have per each point. As I mentioned, if you trade on a bigger lot, so the profit or loss will be higher. Margin impact is the amount of margin required. Free margin should be higher than the margin impact. And if we want to give an example, We go again to the search for symbol. We select, let's say, 0.001. By the way, 0.001 is considered as nanolots. We do offer to trade on nanolots on MT5 account only. So if you want to trade MT4, you will not have that option available called nanolots. It's only available on the MT5 accounts. Additionally, some people are asking what is the difference between MT5 and MT4. The main difference is that the MT5 offer a larger selection of stocks that are available that you cannot find on MT4. So if you do like to trade stocks, I would advise to set up MT5 so you have a larger selection. Also, for those of you who like to trade on using a trailing stop, so also the trailing stop is available on the MT5 account as well. And I will continue with the demonstration that I wanted to share with the relevance of the lot size. So first of all, with a nano lot, if I change the price to $26,000, okay, it means that a take profit order, it means that I'm asking the system to close the position when it reach the price that I set. We have two columns here. The left column represents the price, the right column represents the possible profit that I'm going to have. So with nano lot, when the price hits 26,000, I'm going to make around $26. The amount of money I need for this order is $12. If I change to 0.01 lot, the margin requirement will be $128. So it means that I need 10 times more margin to place the order. The possible profit jumped by 10 as well. So I'll be making 10 times more profit for this position and more loss, of course. But here we are covering the take profit example. And now I will share with you with 0.1 lot. The possible profit will be multiplied by 10 again. It's equivalent to 2,700. And the margin required to place the order again jump by 10, which is equivalent to 1,286. It's moving. And if we change it again to one lot, you can see again it jumped by 10. Margin impact required margin is 12.8 thousand. The take profit is going to be 27,000. Again, for bigger position, it will be 128,000 to place the order. The possible profit will be 276,000. If we change it to 100 lots, the possible profit will be $2.7 million. And the margin impact, the required margin will be $1.2 million to open the trade. And this is with the leverage of 1 to 200. If you are in EU and your leverage is 1 to 20, you will need around $12 million to open this position. I am showing you the smallest position and the biggest position for you to be able to understand the difference of the lot size, because the lot size is the multiplier. The same example I gave on the take profit, also it will be applicable to your stop loss. So if you trade on a bigger lot size, the losses also will be substantially higher. Now I will be sharing with you a product called AVAProtect. Some of you may have heard about this. This is a product that you pay a certain amount of money upfront. You pay a protection fee for a position. This product is available only on gold, silver, and currencies. And I will share with you now. Let's say I choose whatever instrument I want. For the sake of the example, we can choose an exotic pair called USD ZAR. I think the AVAProtect. Be careful when you click on it. It means that you will be paying the protection cost, okay, for that service. We start with a big amount and then we go lower. So you have here durations. The biggest duration you can choose is 2 days. The lot size, it depends on you if you want to trade on a bigger lot or a smaller lot. You can see that it will cost you $37.4 thousand for a protection on USD ZAR for 100 lots. And it says when the protection will expire and what is the duration that you are basically purchasing. What does it mean? It means that within this time frame, if you are having losses on this position, within the duration, if you close the position with a loss, the loss will be reimbursed automatically to your account within the duration. But if you wait for the duration to expire, the negative floating will be reimbursed automatically by the time the duration expires, assuming there is a negative floating. If there is no negative floating, so you will not be getting any reimbursement for this position. So this is the maximum. The minimum will be equivalent to 0.01 lot. And I will just share with you. Also, you see the difference in pricing. Depends on the lot size and depends also on the duration. If you reduce the duration, you also reduce the price of the protection. This price will be deducted as soon as you open the position. And you see here it's red because I don't have enough money for this position and for this price. Now I will give you the smallest lot size as an example, 0.01 lot. The price for 1 hour is $1.54. 3 hours is $2. Goes up to $3.75. So basically, what is required to place an order with AVAProtect? You must have enough free margin to open the position. Your free margin must be higher than the margin impact plus the protection cost. When will the changes appear on your account? You are charged for the protection immediately when the position is open. How will my losses will be reimbursed? Losses are reimbursed under 2 conditions. If you close the position during the protection period, if the protection period expires with a negative floating, the loss is reimbursed automatically. Only losses that occur inside the protection time are covered. How do I make profit with AvaProtect? You must earn more profit than the cost of the protection. What happens if my position continues after the protection expires? Any losses after the protection expires are not reimbursed. So if the protection expires, you can close it and open a new protection, a new position with AVAProtect with a new duration. Only the negative floating inside the protection duration is covered. If there is no negative floating, no reimbursement. It means if the position is in zero or if the position is in profit. So obviously you will not get reimbursed. Examples, if I open small position 0.01 lot on gold with 2 days protection cost of $39.33. The negative floating at the expiration is $100. The reimbursement will be equivalent to $100. You effectively save $60. It means that you lost the $39.33 that you initially paid. Example 2, a larger position. 1 lot on gold, 2-day protection cost is equivalent to $3,933. Just an example. This is when I took the example a while back. If negative floating was $10,000 by the time the protection expires, of course, then you get 10,000 reimbursed automatically, saving you $6,000. It means you still lost the initial cost of the protection, which was equivalent to $3,933. A profitable scenario, it means the position was in profit. 0.01 lot on gold, protection cost $39.33. You end up with a profit of $10. There will be no reimbursement and the position will keep going. In such case, you are still losing because of the protection cost. Example number 4, profitable scenario, larger position, 1 lot on gold, protection cost $3,933. If you end up with a profit of $2,000, also no reimbursement, and basically you are still losing money because of the protection cost. So it means you need to make more than the price of the protection cost. Now we'll go through pending orders. I will share with you now what is a pending order. A pending order will open automatically only when the market reaches the price level that you have selected. Until that happens, the order remains pending. I will share with you now, you can have a look. I remove the AVAProtect option. When I click execute when price hits, I select the price that I want. Any price. That's a 16.3. So when the USD ZAR will hit 16.3, the position will be open. This is the buy position. This is a lot size 0.01, the required margin. I can select the take profit and stop loss. Let's say I want to have a profit of $1,000 and I want to have it closed with a loss of $100. As soon as I click buy to execute the order, I have here the pending order. This order was not executed. It will only be executed when it reaches the trigger price. I have here the stop loss. I have here the take profit. and I have no expiration for the pending order. The pending order will open automatically only when the market reaches the price level you set. Until that happens, the order remains pending. If the price is triggered, but you don't have enough free margin, the order will be cancelled automatically. It means you need to have money to open the position by the time the price reaches. How to set a pending order: select buy or sell, choose your lot size, ensure you have enough free margin at the time the market reaches the trigger point. Click execute when price hits, set the trigger price, set a cancel on date if you want to have it cancelled at some point. If the price is not reached by the date, the order is cancelled. Once created, the order will appear in the pending orders section. This is the example, and over here you can see this is the pending order that I have. The take profit order automatically closes your position when the market reach the price level that you have selected, locking you with a profit. How to set a take profit order: choose the trading instrument, select buy or sell, choose your lot size, ensure you have enough margin to place the order, click more options, take profit. Either you enter the exact pricing point you want, or either you just select the possible profit as I showed you earlier, and then you confirm the order below. Few examples here. You can see 0.01 lot with the same pricing point. You see the possible profit ranges as I showed you earlier. It depends on the lot size that you have selected for the position. And basically, we managed already to cover the main points I wanted to share with you for the webinar. I will say a few points, a few things regarding trading, and the purpose of this webinar is basically to show you the importance of the psychology of trading, because trading is divided by two main subjects. You have the analysis part, where you decide when you want to place an order, and you use different analysis tools to analyze the market. Some of the traders, they like to use robots that's called EA, expert advisor. And expert advisor is something you can buy outside. You can just Google expert advisor that you can integrate with MT4, MT5. You also have MQL community. Or you can find a programmer and design your own expert advisor system, your own EA. And in that case, you don't need a lot of psychology because it's a robot who will be trading for you. But the parameters are being set by you, and also the risk exposure is being determined by you. So when it comes to analysis, you have an EA, expert advisor, is one way of trading and doing the analysis. Another way of trading is technical analysis, which is based on the different pricing points that have occurred on an asset in the past. For example, here you can see the graph of US Tech. You can select different candles. It will show you the different pricing points throughout the year. So as you can see, on the 15-minute, we have the high price of US Tech 100, 25,895. Each candle represents 15-minute time frame. This is analysis based on the technical side. When you change it to 30 minutes, you can go back in a time frame that is more wide, and you can go on and select different type of candlestick charts to see a bigger time frame. We also have the fundamental side where you're basically doing your analysis based on big events or based on economic events, based on big different things related with politics that are also affecting the markets. So these are the type of analysis that you can use. If we recap, we spoke about EA, which is a robot. We also spoke about technical analysis, which is based on the history of the graphs. We spoke about fundamental analysis, which is based on news. You also have copy trading system that you can use. For example, we have AvaSocial. This is an app that you can download, and also you can copy other traders. And this is some examples regarding analysis. But the psychology part is a different thing that you need to take into account when it comes to emotions, when it comes to overtrading, or when it comes to losing money. So you need to have a clear strategy and a clear trading journal, so you can keep a record of whatever you are planning to do in advance before you are doing it. And you need to keep a certain plan, so you will be able to know what is the strategy that you are trying to implement and whether this strategy was successful or not successful, because psychology is also a very important part. We don't want to make this any type of gambling. We want to make an informed trading decision. Therefore, psychology is very important, and you will need to learn how to master the psychological parts of trading, and to become very disciplined as well. We will be running this webinar on a weekly basis on Thursday. We will be sharing a different type of psychological challenges that traders are facing, and also we cover the basics to make sure that you are familiar with how to set your risk appetite, how to set your risk exposure, and how to get yourself more familiar with trading in general, and the importance of knowing what you are doing. And if we go back to the hedging, the two hedging positions that we have open, you can see one of the position is profitable, 2,400. The other one is in a loss of the same amount because it's a hedge. Assuming I want to secure my profit, I can close my sell position with a profit of 2,500. And I can open another edge with the same lot size, 0.17. We'll also go with the sell, so it will be equivalent to the same. You see the required margin, you don't need margin for this. I execute the order. And what I basically did here is, because I see that I have a loss of $2,000 on this position, which is a buy, which means basically the market went down. I collected my profit, which was equivalent to $2,500 profit I made on this position. And now I made another position. So maybe I will keep for you the two positions for the next webinar, so we can see what happened with them. But also, this is a strategy that some people like to use while hedging, because you see one position is limiting the other, and then you can close